Welcome, friends. Normally, during monetary policy, RBI announces so many rates like repo rate, reverse repo rate, SLR, CRR. So you might be confusing what are these terms are. So today we'll see what are the terms and what is the meaning of this and why RBI keep changing this. So first is repo rate. The repo rate is the rate at which the RBI lends money to commercial banks or financial institutions in India against government securities. So here important thing is RBI lends money. Whenever banks or any financial institutions need money, they approach RBI and take money against some securities, and these money are for short term only, not long term. So whatever money taken for short term is known as and is comes under repo rate. And meaning of a repo rate is repurchasing option rate. This is the full form of repo rate. Repurchasing option rate, repo rate. And right now this is 6.5% in India. Earlier it was 6.25, but in last monetary policy on 8th February, RBI increased by 25 basis point to 6.5%. So what is the function of repo rate? It simply provides a policy rate at which RBI lends money to bank. Why it is increased? It is increased to make it costlier for banks, and in response it will be costlier for corporates and individuals to taking loan. Whenever this increased, that means RBI wants to reduce inflation by raising rates. When rates will increase, then capacity to take loan for corporates or individuals will reduce. And once this will reduce, the purchasing power will reduce. Then people will purchase or consume less, and the inflation will be reduced. Whenever RBI requires to increase growth, then they will have to lower down or slash rate of this repo rate. Just opposite of repo rate is reverse repo rate. So in reverse repo rate, RBI takes loan or money from commercial banks, or we can say commercial banks. Whenever they need to park their extra money, they give to RBI and get some this interest from there. Around 3.35% is right now reverse repo rate. Now another term is SLR, Statutory Liquidity Ratio. Statutory liquidity ratio is the minimum percentage of deposits that a commercial bank has to maintain in the form of liquid cash, gold, or approved security. So this should be with banks only. No need to deposit to any other one. So right now this SLR is 18% in India. CRR current this ratio is 4.5%, and this is the percentage of amount in cash, not in any other form. Commercial banks are required to keep with RBI. So with these two, SLR and CRR, RBI manages cash flow or credit flow in country system. Whenever SLR is increased, that means bank will have less capacity to lend money, and of course this will be reduced, liquidity will be reduced in the system. Whenever RBI needs to increase liquidity to boost growth, they will reduce or slash the SLR requirement, and there will be more money in the country, and there is chances of growth increases. Same way, they can slash the CRR requirements. So these are the terms. Now I think you would have clearly understood what are these terms, meaning of these terms, and why and how this is used to increase liquidity in any system in the country or reduce liquidity in the system to contain this inflation or boost growth. For this management or a smooth flow of things, RBI does these things. Thank you. Bye bye.